All right, let's talk about what's going on in the market because right now it is sending some seriously mixed signals. I mean, on one hand, you've got oil prices tumbling. That usually points to an economy that's slowing down. But then you look over at the bond market and it's flashing these big, bright warning signs about future inflation. So, what gives? How can both of those things be happening at once? Well, there's a really fascinating theory that might just connect all these dots. Okay, so let's really zero in on this. This is the big question, right? Why is oil falling at the exact same time that inflation fears are rising? Crude oil prices are dropping, which 9 times out of 10 tells you the economy is heading the brakes, and yet the bond market is practically screaming from the rooftops that it's worried about inflation down the line. It just doesn't seem to add up. How can these two things be true at the same time? So, first up, let's talk about oil. The reason its price is falling is honestly pretty textbook. It's a classic case of too much supply and just not enough demand. On the supply side, you've got this glut of oil. Russia's selling a ton to China and India, and non-OPEC countries like Argentina and Brazil are pumping like crazy. Then you look at the demand side, and, well, China's economy is really sputtering, especially with their real estate crisis. That's a huge drag. All this has pushed crude oil right down to this super critical support level around $59. And hey, if that floor gives way, we could easily be looking at $50, maybe even $40 a barrel. Okay, but while all that's happening with oil, the bond market is telling a completely different story. I mean, a polar opposite story. The yield on the 10-year US Treasury bond, and that's the big one, it affects interest rates everywhere, it just broke out above a really important trend line. Now, when that happens, it's a classic signal. It means the smart money is starting to bet on higher inflation coming down the pike. So that's the real question, isn't it? What on earth does the bond market see that the oil market is completely missing? And this is where we get to the grand theory that could actually tie all these conflicting signals together. It all comes down to the idea that the market is looking way, way ahead, and it's starting to anticipate a huge, almost monstrous shift in the US economy, specifically around the year 2026. So, what's the core idea? It's that the market is betting on a massive change in how the economy gets stimulated. We're talking about a shift away from the kind of central bank stimulus that really helps Wall Street and towards direct government spending that benefits Main Street first. And believe me, that fundamental change in how money flows into the system, it has absolutely massive implications. Okay, so to really get our heads around this, let's put these two models side by side. The new stimulus idea versus the old way we've been doing things for the past decade or so. Let's just trace the flow of money for a second. In the old way, the Fed injects cash, right? And where does it go first? To the big banks, to financial institutions, to Wall Street. That pumps up the price of stocks and bonds. And who feels it last? The workers on Main Street, usually in the form of higher prices for everything. But this new model, it completely flips the script. The money would flow directly from the Treasury straight to Main Street, to real projects and real people right from the get-go. So how would this actually work? Well, the theory goes that the Treasury could use its huge cash reserve, we're talking $900 billion, and spend it directly on real-world projects. That money goes straight to government contractors. What do? They hire people, they buy materials, and boom, you get a direct boost to employment, to wages. And that creates inflation in the real economy, not just puffing up the value of financial assets. Okay, so keeping that new stimulus model in mind, let's circle all the way back to our original puzzle. Because suddenly, those conflicting signals from the oil market and the bond market, well, they actually start to make a whole lot of sense. You see, bond investors are always playing the long game. They're looking years down the road. They're not worried about today's weak oil prices. No, they're looking ahead to 2026, and they see this potential wave of direct government spending coming. And they're betting that this will create some serious real-world inflation. So what do? They demand higher yields right now to protect themselves. That breakout in yields we saw, that was basically the market firing its first major flare gun, signaling that this new reality is priced in. So the natural next question is, what does this mean for the Federal Reserve? Where do they fit in? Well, this new dynamic puts the Fed in a very, very tricky spot. Yeah, the Fed is basically going to be walking a tightrope. On one hand, they'll probably want to cut interest rates to help out all those businesses on Main Street. But on the other hand, they absolutely have to avoid expanding their own balance sheet, their version of printing money. Because if you combine the Fed printing money with the Treasury directly spending money, wow, that would be like throwing a gallon of gasoline on a bonfire. You could trigger a massive inflationary bomb. So, the million-dollar question, what does all of this mean for stocks? Well, if this theory holds, it could point toward a year-end S&P 500 target somewhere in the 7,000 to 7,300 range. So yeah, that implies there's still some room to climb from here. But, and this is a really big but, it's not going to be a rocket launch straight up. Not at all. Right now, the market is kind of stuck in this sideways grind, just churning, struggling to break out. It's trying to digest this really complex new reality. You've got the promise of future growth on one side, but the current weakness we see in oil prices on the other. So I'd expect more of a slow, steady climb, not a moonshot. So while the whole market is trying to figure out these huge macro forces, we can actually see a similar kind of dynamic, this game of control, playing out on a smaller scale. And for that, let's look at a really fascinating case study over in the world of crypto. It shows exactly how Wall Street can pull the strings and manage prices. So here's the deal. Some of the big Wall Street players have found this really clever way to influence Bitcoin's price without even touching it directly. They use a proxy, a company called MicroStrategy, which, as you may know, holds a ton of Bitcoin. By playing games with MicroStrategy's stock price, they can put a ceiling on Bitcoin's price. And the key number for this whole play is $190. If you look at the options market, you can see there is a massive wall of selling pressure for MicroStrategy's stock sitting right at that 190 level. It's like a big invisible ceiling. So what does that mean for us? Well, as long as these traders can keep MicroStrategy's stock pinned below that 190 wall, they're also effectively putting a cap on Bitcoin's upside. That makes MicroStrategy stock a really important leading indicator to watch. If you see it break decisively above 190, that could be the signal that the selling pressure is finally gone, and it might just open the floodgates for a big rally in Bitcoin. And this brings us right back to the big picture, our central theme today. You know, if we really are moving into a new economic world, one driven by direct spending into the real economy, it forces us to ask a really fundamental question. In that world, what's more valuable, a financial asset or a real one? That's definitely something to chew on as these confusing market signals continue to play out. Thanks for joining me for this deep dive.